Hi, my name is Clive and I'm a director of Peak Accountancy Training. We provide online courses that you can use to study towards the AAT exams at levels 2, 3 and 4. If you are interested in our courses, please do visit our website www.peakaccountancytraining.co.uk. Well, in this recording, I'm going to be walking you through task 2 of the AAT sample assessment 2 for the PCTN exam. So let's have a look at task 2, which is worth 10 marks in total, split into a number of different requirements. In the first requirement, we are asked to identify whether the following statements refer to the activity of planning, control or decision making. Now these are 3 activities that would fall within the domain of a management accountant. Management accountants responsible for analysing information, providing costings, providing information to the managers of the business to help them to plan for the future, which they can do in the form of budgeting, for example, to help them control their business by measuring performance and output, for example, to help them to make decisions about what products, what price, what services, what geographical areas, just to name but a few decisions that potentially need to be made. On top of those 3 areas, then management accountants will also be helping to evaluate performance overall and also to put valuations on items, to put costings on items as well. So we've got to look at each of these statements and decide whether that statement is referring to the activity of planning, control or decision making. Let's have a look at the first one. The act of making a choice based on information received. Well, without even looking, I'm going to say that that is a definition of making a decision. So decision making, forecasting at different activity levels, forecasting the future, forecasting what the volumes of sale would be, forecasting what costs would be, forecasting for what revenues might be. So forecasting is all part of the planning process, looking into the future, helping the business to make plans to ensure that they have the resources they need to meet the demands of their customers. And finally, the comparison of budgeted results to actual. We are now monitoring performance, which means that we are basically helping to control the business, making decisions to control the business, to keep it in line with its plans for the future, to make decisions, to change processes maybe, to make them more efficient or more economical. But that comparison here, by comparing actual results against what the plan was for that period, is helping to understand what went right or indeed what went wrong, and therefore helping managers to control the performance of the operations. Now our next requirement moves us into valuations, and particularly inventory valuation. If we are a manufacturer, then we are going to be buying in materials to use in our production processes. If we're a retailer, we're going to be buying in items to resell. What we need to be able to do is to put a value on any of these items that are left in inventory at the end of the financial reporting period, because they would then be current assets of the business. Now, the 3 valuation methods that we need to understand are FIFO, which stands for first in, first out, and is the valuation method that mirrors, I guess, real life, particularly in terms of perishable products. If you consider your own supply of milk at home, then if you're thinking about it, when you're making yourself a drink in the morning, you would use the oldest milk first before it perishes, before it becomes unusable. And for many businesses, they will be making sure they use the oldest inventory first, particularly if they are dealing with items that will go out of fashion or items that indeed will perish. So FIFO, first in, first out, is the valuation method that tracks that sort of logical, that physical process. LIFO does the opposite. LIFO stands for last in, first out, and basically means that when you are valuing your inventory, when you're accounting for your inventory movements, you will assume that the items that have been sold or the items that have been sent to production to be used in a manufacturing process are the most recent that have been bought in. So the opposite to FIFO, which assumes that what you've issued is the earliest. AVCO is somewhere in between the two, and it is a weighted average method of valuation, and it basically involves you working out just before any issue from inventory what the average unit cost is of what you're holding in inventory, and it uses that average unit cost to value any issues. As well as being able to value our final inventory, what we're trying to do is track the cost of goods sold. We need to be able to understand what materials have been used and how much we paid for those materials to come up with an accurate costing that will enable us to be able to calculate our profit. So, which inventory valuation method best describes the following statements? Costs issues using the average inventory price. Well, that is exactly how the weighted average approach, AVCO, the average costing method, that is how it works. Basically, every time we buy something into inventory, we recognize that the price may well be different from the last time we bought something into inventory of that item. Every time something is bought in, we calculate the average cost of everything of that type that we hold in inventory. That average unit cost is then used to value the issues. What about the second statement then? As the purchase price rises, this method will give us the highest profit. Well, if you consider every time you buy an item into inventory, the price is increasing. When you calculate the cost of the issues, if you use the first in, first out method, that means that the issues to your customer or the issues to the production process will be at the relatively lower prices of the earlier purchases. Now, if we just take the simple example that you're a retailer buying things in to sell them to the customer. In a period of rising prices, if you use the first in, first out method, then the cost of your sales will be relatively lower than if you were using the LIFO method, last in, first out. That would assume that what you've sold to your customer is the most recent purchase at the higher price. That would give you a smaller profit. So basically, it is the FIFO method that would give you the highest profit. Lowest cost because it's the earlier purchases when prices were lower. The AVCO method, of course, would always end up with a costing somewhere in between FIFO and LIFO. That's why I discounted that as a potential answer. So what about the last one? As the purchase price rises across a period, this method gives the highest closing inventory value. Well, if we think about FIFO and LIFO, if we are using the FIFO, first in, first out valuation method, we are assuming that the issues in a period are being taken from the older and therefore cheaper items that we've bought in. That leaves us at the end of the period with the more recent purchases, which would be at the higher price. If we were using LIFO, we would be assuming that the issues from inventory across the period were always being taken from the most recent purchases. They're at the higher prices. That leaves us with items in inventory at the end of the period that are older and priced lower. So the answer here is also FIFO. Issuing the older inventory first means we're issuing items at the lower purchase price, leaving ourselves with items at the higher purchase price. Our closing inventory value would therefore be higher. Our next costing method is looking at labour costing. And what we've got to identify is the costing method that is being used in the following scenarios. Are we using a time rate, an hourly rate, plus additional payments for overtime? Are we using a piecework system? Now, a piecework system is one where employees are basically paid for the items that they produce. Or are we operating a guaranteed minimum payment system? Sometimes with piecework systems they can be seen to be unfair, because if employees haven't been able to produce as much as they are capable of or they would like to because of something that is beyond their fault, beyond their responsibility, so for example production systems breaking down or software crashes, for example, that means that the employee is going to be unfairly penalised for not completing the work that they set out to do if they're paid on a piecework basis. So the guaranteed minimum amount kicks in and they'll basically be paid at least the guaranteed minimum, or if they have produced enough that means their pay would be more than the guaranteed minimum, they will be paid based on what they have produced. They will be paid on the piecework basis. So let's have a look at our scenarios and see how they match up. We've got two scenarios, A and B, to consider. So in scenario A, production staff are paid for 35 hours per week at £17.50 an hour. They are paid on a time rate. So they're paid based on the hours that they work. Any additional time above that contracted 35 hours is paid at a premium, paid at time and a half. So what we've got going on here is a mixture of a time rate and overtime. What about scenario B then? Production staff are paid £10 for each unit they fully complete. So we're talking now about a piecework system. But they're paid at least £600 at the end of the week. So that is explaining a guaranteed minimum payment. If they haven't finished enough units to pay them at least £600, then they will be paid the guaranteed minimum payment. If they've produced enough units that means their pay on the piecework basis would be more than £600, well then they would be paid based on what they've actually produced. So scenario B is a guaranteed minimum payment system. So for D, we've got to calculate the labour cost per unit for each of scenarios A and B. We're told to round our answers to 2 decimal places. The additional information that we've been provided with is that 58 units were made in the week and the full 35 hours were taken. So scenario A was the time-based approach. The staff have worked 35 hours. Each of those hours paid at £17.50 means the total wage cost would be £612.50. That £612.50 is for 58 units. We're asked to calculate the labour cost per unit. The total labour cost is £612.50, 35 times by £17.50. If we divide that £612.50 by 58 units, we get £10.56, which is the labour cost per unit. What about for scenario B then? Well, for scenario B, we've got this piecework with a guaranteed minimum. We're told that we've made 58 units. So in scenario B, we're told that £10 is paid for each completed unit. So 58 times 10 is £580. However, because of the guarantee, £600 will be paid. £600 is being paid for the production of 58 units. So the labour cost per unit is 600 divided by 58, which is £10.34. Okay, well that brings us to the end of task 2.